Hey, good morning, everyone. Hope your Saturday's off to a good start. I'm still kind of reeling from the Lions from 3-4 weeks ago, whatever. Anyway, sorry I'm starting this a little bit late today. Of course, YouTube is doing something. I was going to show a video on I interviewed the head of an ETF provider, and I'm going to start to use a little bit of his ETF. So we had a 20-minute interview, and of course, I can't get the darn thing to work within this system. Don't know why. So I was panicked the last 5-10 minutes to try to figure out what's going on with it. So I've got another short video of another holding that I'm going to add in a little bit here, and then we'll jump into some slides. But it's going to be really short because I was basically pretty much the other video was going to be the bulk of what we're doing. And when I show this other short video, I'll try to do a last second Hail Mary and see if I can figure out what's happening. But it just doesn't look like I'm going to be able to get this thing up and running. But so the other holding that I've got that I'm going to talk about is a very heavy kind of value holding. So instead of the growth, we're gonna focus on value. And what I talked about last week was sort of how some of these growth stocks are just ridiculously overvalued. And I'm going to address it a little bit more here today because I did get some more questions on it. So I just thought I'd try to explain my position a little bit more on that. So at the end of the day, as an investor, what your goal is to get cash. So when you look at a company, when you look at a piece of real estate property, you might turn into a rental. If you're going to buy another little small business, if you're going to buy a franchise, anything that you're doing in business, you're looking at, say, okay, I'm outlaying this cash. What kind of cash am I going to get in return for that? And that's what you're looking at. And it seems like really, I mean, it's kind of morphed since the 90s, when in the early 2000s, when at that point, everything was just about capital appreciation, like what the markets do. Before that, if you're talking the 80s, 70s, 60s, everything like that, you really looked for what kind of cash were you going to get. And you probably remember your parents or grandparents or great grandparents, and what they did is they built a portfolio that they lived off the dividends, and that's kind of how it was, because you look for good companies provided return to the shareholders. So you had you probably had your grandfather and grandmother who were living off the dividends from GE and GM and Honeywell and IBM and all that. And that's that plus some bonds, and they didn't worry about it. They weren't expecting GM to appreciate in price, 10-15% a year, because, they were getting most of their value from dividends. And if you look historically, the two things that really do tend to provide a lot of the return, one of them is dividends. But the other thing is buying things cheap. Value over the longer term does much better than growth stocks, because the outlay of cash, you're getting more cash back in return. And there's been all kinds of the great investors, the Warren Buffetts. That's what they kind of built their entire philosophy around. Now, it just seems like really, like I said, since the 90s, late 90s, early 2000s and on, it's kind of moved away from that, and everyone looks for what's this thing going to appreciate. And it's even been real estate. That's why we got into such a real estate problem in the early 2000s, is because people would buy a property to rent and it wasn't going to make cash flow. So they buy the property and they'd actually lose money on a month-to-month basis. But they're like, well, hey, if the property goes up 10, 20% a year, I'll be fine. And, you would be, but then you find out that it doesn't work that way. So I think we're kind of back in that spot right now with some of the Magnificent Seven stocks, things along those lines. So what you want to do as investors, kind of zig when they're zagging and look for value. Now, value has done absolutely nothing here the past couple of years, and I look like a fool for being in it, quite honestly, to tilting that way and staying away from the Magnificent Seven. You're going to look like an idiot. It's like you can look like an idiot now, or you can look like an idiot later. So anyway, I guess that's my long-winded approach to kind of explain this holding. So Meb Faber, he looked at basically what kind of cash are you getting as an investor, but it's not strictly dividends. So most or a lot of the funds that are out there look at how am I getting more cash from the company I invest in through dividends. So they're dividend focused themes that are out there with different mutual funds and ETFs. Well, he says, well, that's not the only way that you can be provided value. You could be provided cash flow. Companies could pay debt off quicker, which in a way is providing you cash flow. Or a company could buy back shares, which also helps improve your cash flow. You're getting more cash from the company that way. So this is just a quick little video that we'll play here. Okay, so that's just a really quick video. Still messing around with this thing, trying to see if I can get the other one to work. I might have a little bit of luck here, I think. And it looks like maybe I do. So that's one of them I'm going to slowly add in here. I think I did get the other video up, so I'm going to try to fire that up. And if it does happen, then you can get a look at the one on the emerging markets. So this one specifically kind of set up. I like this conversation. It's a little bit longer. I might not show the whole thing, but he talks about what are emerging markets. So, you know, I've talked about it. Emerging markets are going to be Eastern European, South America, India, China, you know, things that where the countries are really starting to develop into more westernized nations. And so he gets into the demographics on this. And what I kind of find intriguing about this holding is what he's trying to do is get on the front end of sort of the same big move that we've seen in the US markets dating back to the 1990. So many of these emerging economies, they're starting to get people who are becoming consumers. They're starting to online shop. They're starting to get cell phones, but they're so far behind us, and their population is so big that the potential is enormous. But now, just like the United States, investing in those companies like Amazon and Apple and Nortel, all the cell phone based, computer based online shopping, all that stuff, was very volatile. But wouldn't you have loved to just get in an Apple and Amazon and all that in, say, 2002? You probably would have loved it. So, oh, good question. China is an emerging market. I mean, it still is. So emerging markets, it's the second largest economy, but emerging markets are still, the reason they're still emerging is they haven't really developed a solid banking, and they're going through that right now. So it's still so much government control that they don't have a fully functioning currency. They tied it to the U.S. They're pegged it to the U.S. so it doesn't float at all. They don't have a developed, like I said, banking system. So there's still a lot of things that they don't have that most typical Western economies do. And most of that's because they want control, but they're starting to feel how that control is not working for them. So anyway, let me see if I can get this other video cranked up here. Okay, Kevin, welcome back to the show. I really appreciate your time.
Thanks for having me.
Yeah. So, last time we talked, and one of the reasons I really wanted to talk to you is, you're really doing something unique in the emerging markets space. And the other thing is, I don't know when it's going to happen, but at some point, emerging markets is going to have its day in the sun again. Everything in life is cyclical, especially in investing. And when you compare it to U.S. markets, it's emerging markets have trailed, but there's going to be a period, who knows when, but emerging is going to kind of come back and lead for a while. So I think, I thought it last year, and I still think it now. I think there's a really compelling case for what you're doing, and just wanted to get the information out to investors on exactly what that is. So, I'm going to pass it over to you a little bit to talk about generally investing in the emerging markets, and particularly, you mentioned you like to talk about specifically India. So I'll kind of throw it over to you.
Okay, great. Well, so let me first just give a high-level review of what are emerging markets and why investors should care about emerging markets. Emerging markets are basically, they're basically the world. We're talking about most of the world's population, about 90% of the population. And in terms of where are they, like, which countries are emerging markets, 60% of this story is Asia, with China and India each being about a third of emerging markets. And then the other third is spread around Southeast Asia, Latin America, and then all sorts of countries between Africa, the Middle East, and Eastern Europe. So that's what it looks like on the map. Again, fundamentally, this is all about where the people are. Most of the world's people are in emerging markets, and they're younger than developed markets, so their demographics are more favorable. And so you've got a lot more people moving into their peak sort of productive years. And ultimately, when you sort of take the whole emerging market story apart, the thing that's actually emerging are the people. You've got billions of people, and they want stuff. They want the stuff that we take for granted: more food, more and better clothing. They want appliances. They want to be entertained, go to a movie, take a vacation. They want a motorized vehicle, and they want their kids to go to college. And that's the story. I didn't have to figure this out. It's very well documented. So that's what you need to know about emerging markets. And what we do is capture this story, but this story as it combines with two other so-called megatrends. So again, as mentioned, the first part and most important part of emerging markets is billions of people that want the stuff that we take for granted. But what's also happening is that those billions of people are getting their first ever computer. So while I've had a computer for, over 30 years now, most people are getting their first computer today. And it's not a desktop computer, and it doesn't have an Apple logo. The Android-based smartphone is getting better and more affordable every year. That is the computer that the world is getting for the first time again today. Millions of people in India right now, every month, getting their first computer. And when they get that, they're getting their first internet connection, something I first got in 1995 on a telephone line in San Francisco. So you're giving billions of new consumers their first computer, their first internet access, and the result has been this incredible story of growth. So all across emerging markets, the same things that have happened here are starting to happen. And for investors, over the long term, that's been very good, but that's not without a lot of volatility. And as you can see, a major, major decline in the last couple of years, largely due to, sentiment going negative on China. And in fact, the reality is, though, that China's been most of the story so far. So if we look at that same revenue that I showed you earlier, this revenue, if we looked at it differently, you can see that China's been 80% of the story. So China, in many ways, has driven the story so far. But what makes the next decade or 20 years exciting is that you have 5.5 billion people outside of China that are also getting their first smartphones and also getting the internet for the first time. And while China's e-commerce market is the most developed in the world, the rest of the planet, including India specifically, is really just getting started. So that's what we do, and that's why today we're super focused on the India opportunity.
Okay, great. And just to jump in there real quick, talking about China, do you think that when you look at it, you see opportunities in China right now, or do you think that they're having some sort of internal, you hear debt issues, and that's going to pretty much keep China down for a little bit longer?
Well, I don't make predictions about the stock market in the near term about any part of the stock market.
Sure. But
I can tell you that sentiment's as bad as I've ever seen around China and Chinese internet companies. And as I'm as an investor, first and foremost, I'm an Omaha, Berkshire Hathaway kind of person. And as we say in Omaha, you pay a high price for a cheery consensus. So there's a lot of doom and gloom around China, and the prices reflect that. So I'm not, we're not giving up on the China story or the China internet companies, but it's definitely, it's in a tough time, and it's got, it's suffered from a couple of years of, I think, overblown fears about regulations and delisting and some other threats that people perceived. But now it also has some very real world issues, including a slowdown in their housing market that may, in fact, keep the economy from growing as fast as it might have otherwise. But let's remember, we had, a major housing related crash to our economy, and we recovered. And I suspect that even if things go, even worse with China's real estate sector, they'll recover and get through. They're smart people, and they actually have a pretty good balance sheet, all things considered.
Okay, great. Well, yeah, let's dig into India then and talk about that.
Well, so India is, as I said before we started, I mean, it really is the perfect emerging market. And again, if you go back to what I started with. Why do you want to invest in the emerging markets to start with? Lots of people, they're young, they have a fast-growing economy or fast-growing economies, and most of that growth is in consumption. And in every one of those categories, India isn't only number one, it's number one ever. So here's a look at the population. So people may not know that about a year ago, 10 months ago, according to the World Bank, India passed China to become the largest population on the planet. And if you look at the go forward years on this chart, it's only going to get bigger and bigger and bigger, while China's population is basically peaked. And so India is not only the biggest country, it's the biggest country ever, and it'll be the biggest country ever again tomorrow and tomorrow and tomorrow. I mean, it's unprecedented in its scale. To put it in perspective, if you left out China, India is bigger than every other emerging market combined. So you have Indonesia, you have Brazil, you've got parts of Africa, Southeast Asia, but all of those different countries and all of the different risks and issues that they face, all of them combined equal India, or even less than India. So in terms of analyzing the situation and the opportunity, you've got so much opportunity packed into one spot, and the opportunity looks really unprecedented because it's not just the biggest population, it's the youngest population. It has the fastest growing economy, major economy in the world. Now, I'll point out that this slide shows the estimates for this year as 6.3%, and the estimates have been 6 to 6.5% for India's growth. But the last 2 quarters, India beat the estimates by 1 full percentage points and grew at over 7%. So biggest, youngest, fastest growing. And where is that growth coming? It's coming from consumption, just like we saw in China as it exploded in terms of its economy. So biggest, youngest, fastest growing. And not only is the consumption booming, it's actually going to be, by most estimates, bigger than China in the not too distant future. So India has all of those things going for it, but it also has some other things going for it that, again, set it apart. I mean, this is really in many ways, and quite literally, this is a once in a lifetime opportunity. There's not going to be another population the size of India's coming into this growth stage, certainly anytime in my lifetime. So all of those things are lined up. And then the other elements that you need and have with India are, first and foremost, India is the largest democracy on the planet. So a lot of the fears around China have been government related and so forth. India, by contrast, is the world's biggest democracy. And it's not only a democracy, but the government is pushing digitization. And they have really unleashed and I think quite brilliantly built a technological platform for the country to leverage and grow on top of, which I'll talk about in a second. So you've got a democracy, and what Modi and his party have done since they've gotten into office 10 years ago, and Modi is the prime minister. Again, he's serving his second 5-year term, which is just ending. He will get a third 5-year term, and he's taken this country with a lot of bureaucracy and a very difficult place to do business. And he's running the country like a business, and he's cutting out all sorts of fat, all sorts of bureaucracy and red tape, making it easier to do business. And he's also, very importantly, investing in the infrastructure. One thing that I saw over the last 20 years was, when I first got into emerging markets, China and India were neck and neck, but China was investing in the world's greatest infrastructure. India, meanwhile, was sitting on their hands. The roads weren't paved. The power didn't work. You had brownouts at the factories. They've finally, in the last decade, turned that around and basically doubled all of the infrastructure that they had in the last 10 years. And they're still working off $1.5 trillion comprehensive plan that includes roads, airports, seaports, all the things that India needs to modernize. India also has a tech sector that's basically as old as ours. The Indian tech sector, the outsourcing of U.S. Office processes to India started before I was born, basically in 1968 by Tata, first Tata Computer Systems, and so you have an ecosystem of technologists in India that are unmatched. And in fact, they're not just in India. There are 25 S&P 500 companies that have Indian CEOs. So again, to make all of these economic advances and to develop an economy, you need people. And there's no emerging market or developed market, frankly, other than a couple that have anything like the human capital that India has. And then the final thing is something that I don't think that, I'd be quite surprised if any of your listeners know about this, because I don't think most professional investors know about this. But India has a secret weapon for itself that is something that I didn't fully appreciate even a year ago. Only 9 or 10 months ago did I start to appreciate what India has built for itself, which is basically a digital public infrastructure, a series of technology-based programs that stack on top of each other and provide a foundation for digital growth, which they call the India Stack. And this man here, he's really the hero of the story, and he's one of the founders, actually, of Infosys. And what happened, he's also, I should mention, currently the chairman of Infosys. And what happened was, 15 years ago, one of the problems India had in developing was that nobody had identity cards. Nobody could prove who they were. And less than half of the babies even got birth certificates. So as you can imagine, it's hard to modernize an economy when nobody has ID. And they wanted to introduce an ID card system for the country. And they asked this man, Nandan Nilekani, to be the chairman of this program. And he agreed to do this, but he insisted that every one of the identity cards, every person that got an ID card would also be registered in a biometric database with their fingerprints and an eyeball scan, biometric information. So this launched in 2010. It's called Aadhaar, which translates to foundation. And what they've done with it is not only use it to provide a database for everybody, but they used it to allow people to open bank accounts with just their fingerprints. And so you now have essentially the entire population in a digital database. There's a know your customer layer as the second layer that they've used to open 800 million bank accounts. And the mobile phone carriers have used it to open about 500 million new mobile phone subscribers. So you've used this biometric database to not only give everybody an identity card, but allow them to instantly prove who they are and open and bank accounts, get into the financial system, and get into the information age. And they added, after that, a payments layer that allows for real-time instantaneous payments, which now India accounts for about half of the entire world's real-time instant payments. And you've taken an economy that was basically 95% paper-based cash currency 7 years ago, and now it's almost 80% digital. And so India, it really is the perfect emerging market. It's not only has all of those things the basics, the large population, the young population, the growth of consumption, but it's also got this digital platform, and it's happening at a time when you can now buy a pocket-sized supercomputer for $12 in India. So when China got into this growth phase, nobody on the planet had a smartphone. Now the smartphone is ubiquitous. And so the India story is incredibly compelling. And not only will their economy grow, but the internet economy should grow hundreds and hundreds of percents in the coming decade or two. So that's why I think investors really ought to be interested in India, and in particular, this digital India story.
Okay. Yeah, that's extremely compelling. And so how did you all kind of develop your index for the India internet economy? How do you go about putting together your ETF?
Sure. So, everything we do is pretty simple. So what we want to do is invest in the internet and e-commerce companies that are benefiting from these three megatrends. So the app economy, the FANG stocks, right? The same things we've seen here, right? We want to invest in the Amazon.com of Brazil, and the DoorDash of India, and the Uber of Indonesia. And frankly, this was pretty easy to see when I started our original fund 10 years ago. You could already see that, the trips to the Target store were going down, and all of a sudden I knew the UPS driver on a first name basis. So all of these trends were very clear to me and to most of us, right? Amazon was killing it, and Sears and JCPenney were going bankrupt. So it's the same thing as we've seen in other parts of the world, but there's just a lot more people in emerging markets. And so our process is first and foremost to identify all of the emerging market companies that are part of the story. And there's some challenges in doing that because, first of all, ultimately every company gets put into a database, right? And the boxes for what you are, it starts with the 11 first level layers of the GICS, the sector level, and then it gets more and more detailed. And so you end up getting put into different sub boxes. So the first thing we do is we look at all of it and figure out where the internet and e-commerce businesses are. And because they may not, there's no bucket at the end that says internet, right? So it's about finding those. And then once we've found them all and vetted, because one of the other problems in the traditional indexes and the databases is that a lot of these companies, in fact, most of these companies, they're founded by the smartest kid in Brazil or the smartest kid in India who goes to Harvard or Stanford or the IIT Bombay or whatever it is, some great school, and then they go to work for Google or Microsoft or Morgan Stanley or Apple. Then they go back and get their MBA at another great school, and then they start these internet companies, and they're getting funded largely by U.S. institutions. And so they end up going public either on the NYSE or the NASDAQ or some other market, and they're getting left out of the indexes. And so we don't care what stock exchange you're on. For example, Mercado Libre, which trades on the NASDAQ with the ticker MELI. This is an absolute juggernaut of a company. This is the Amazon.com of Brazil and all of South America. And it's also the bank, right? Imagine if you went to Amazon.com for your checking account and bought your mutual funds at Amazon or your ETFs at Amazon. That's what Mercado Libre is. And it's, again, an absolute juggernaut. It's not in the Vanguard fund. It's not in the iShares fund. Why? trades on the NASDAQ. The other problem is that a lot of these companies, they put their headquarters in a certain country, but that's not where the business is. So Southeast Asia, Indonesia, Vietnam, these places, all of the internet companies are headquartered in Singapore, which the database says is a developed market. And so all of the Southeast Asian internet companies, they're not in the Vanguard fund or the iShares fund. So we don't care about what stock exchange you're on. We don't care about what country your mailbox is. We care about where's the actual business. And this is one of the big disconnects in traditional approaches to indexing in emerging markets. So as long as you are an emerging markets internet company, that's the kind of the most work is to find them, make sure that they are what we're looking for. Then it's about minimum size and liquidity. And as long as the companies meet those, we'll include them. And then we rebalance every 6 months and pick up, new IPOs or get rid of things that have shrunk. But usually it's been new IPOs. And in the case of India, the reality is that for the first 7 years of our existence as a business, we had very little Indian exposure because there was only 2 publicly traded internet companies. But finally they started. We, the earliest, and all of these businesses are things that your listeners, they may not use these versions, but they use something like it probably. So the travel app of India, Make My Trip, was one of the first companies we owned when we launched, 9.5 years ago. Again, do you want to get a hotel room? You want to get a reservation at a restaurant? You need a train ticket? Make My Trip. You want food delivered to you? Zomato is the DoorDash of India. But one thing about the India opportunity that's important, obviously, to make things short and simple, I say things like the Uber of Indonesia or the DoorDash of India. And that gets you 80% of the way there, right? Sometimes maybe 90%, maybe 70%. But the India story, because this whole story is in such an early stage and it's a green fields kind of opportunity, Zomato's not just a play on delivery of food, it's a play on the future of eating food in India. So if you think about, when DoorDash and Uber Eats showed up here in the United States, we had plenty of restaurants, right? We had no shortage of restaurants. If you get off the highway somewhere, you'll probably see, a Burger King and a Taco Bell and hopefully an In-N-Out Burger or a Chick-fil-A or whatever you like. But there's no shortage of restaurants. Again, part of what happens in emerging markets is people don't eat out at restaurants, and then they start to make more money, and then that's one of their first sort of luxury spends. I'm going to go out and eat at a restaurant. And so Zomato, it does deliver food, but its fastest growing business is actually selling food to the restaurants themselves and other restaurant supplies. So again, becoming sort of the operating system almost for the entire restaurant industry development in India. So Zomato, one of the companies we own, another example, online beauty. Again, you look at the demographics for, how much money does the average person spend on, beauty products or other types of products. So low right now, but all of the demographic numbers indicate this is going to be an exploding area. Nika, which was founded by a woman who was actually an investment banker who promised she would become an entrepreneur by 50, and she did, and now she's one of 2 self-made Indian women billionaires. Online insurance, again, the demographic numbers, you start going $5,000, $6,000, $7,000, $8,000, $9,000 a year of disposable income. Insurance, one of the top things on your list, online gaming, and finally, online payments. So this is this is, I think, what investors ought to be interested in. I think that people ought to be interested in India. It by all accounts is, as far as I can tell, the best emerging market, and likely there won't be anything else like it in terms of the size of the opportunity. And I really do think that all the pieces are in place now for it to continue its really incredible growth. There's definitely risks, but the opportunity looks good, and I think long-term investors who can buy and put it away for 5, 10, 15 years, I think they'll be well rewarded.
Okay. Yeah. It's interesting just to see how you've come about putting this ETF together. And, I agree. I think there's just such an upside here as they become more developed. And just the fact that, like I said at the outset, emerging markets sort of has been left for dead here the past few years, especially China. So there's compelling reason based on valuations, and just that alone should draw people's attention to these areas. So Kevin, if people wanted to learn more about EMQQ and your fund offerings, and where should they go? How can they follow you?
They can find us at emqqglobal.com, and they can also email me or reach out or find me on LinkedIn.
Okay, I'll stop it there. The rest was just sort of a finish up and conversation like that. So I will end that there. But I mean, it's just an interesting, it's almost like you kind of get an opportunity to maybe, invest in a sector that's done so well in the United States, but you're doing it very early again. Now it's, he alluded to it's going to be very volatile, and I expect that to continue. But I think there's some compelling valuations just for emerging markets in general. And I'm going to quickly show a few slides here. I know we got started a little bit late, so we're kind of running a little behind, but I'll try to move quickly through this. So just in general, what we've seen is that emerging markets have really trailed the United States, over the past few years. And I've shown things before, just how international in general has really trailed the U.S. and offers a much more compelling valuation than what the United States market offers, and especially for emerging markets. So this is just a chart, for the past roughly 5 years. And you can see emerging markets have gone nowhere in 5 years. I mean, absolutely nowhere, whereas the U.S. market has. And the thing is, you still have a lot of earnings in a lot of these emerging markets. Now, this is just the general emerging markets, like Kevin talked about. It's focused just on the stock markets of the emerging economies, not looking at where, it could be, like you said, Singapore companies that are doing a lot of business in the emerging markets. This is strictly, Vanguard emerging markets, just, all right, we're going to invest in China, we're going to invest in India, companies only on their stock exchanges. But everything has been cyclical. There's periods where emerging markets does so much better than the United States. We saw that really happen after the 2008 bubble. For about 6 or 7 years, emerging just really dominated. But so we're at levels that there's a good case for emerging markets to begin with. And then you throw on top of that, possibly, being in a situation where the India specifically area seems to be pretty good. And right now, India, as far as an economy, is really kind of booming. It's one of the few economies in the entire world that's seeing substantial growth right now, plus 4% per year actual growth. And So you look at the trends that he talked about, everything like that, and it's still in the very early stages. This is just his fund for the past, from its inception in 2021, and like the rest of emerging markets, initially it went down. So it was very much tied to what emerging markets were doing. But because of its India exposure, it's really kind of starting to climb back up, and you do a pretty good job. Who knows what's going to happen? You can see from the chart, even over a couple year period, there's a lot of ups and downs with this fund, without a doubt. But if you just add a small percentage of your portfolio to it, it could have a very big impact down the road. But there's going to be a lot of ups and downs with it, just as there was for a lot of the internet and e-commerce companies here in the United States. So I would expect to see that that India will see those ups and downs too, just like we did here. But they're already kind of coming off a big down. So it could be an opportunistic time to jump in with a little bit of money on that. So this isn't really a value play. It's more of a strategic long-term play, trying to focus on the growth of it. Now, the other holding that I had this short 2-minute video for, the Cambria shareholder valuation, shareholder yield. This is sort of just giving you an idea of kind of the value. This is a strong value play fund. So it's mostly what they call mid-cap value. So when you look at this chart, you see the word category, it's just talking about mid-cap value. So even compared to value stocks, it offers even more compelling valuations. And then it also compares at the S&P 500. So the price to earnings is extremely low. You're sub 10 on this. So that's really a low number. Again, just the average for the US market historically is 15. So, I mean, this thing's offering a compelling valuation there. Price to book, again, what that number is, it's looking at the total assets of the company. So what are you paying on a price? If this company went out of business and they had to liquidate all of the assets, how does that look for you? So, this is a 1.7. So you're only paying 1.7 times the assets. Whereas, if you're looking at the S&P 500, you're paying 4 times assets. And then price to sales is very low and compelling. The big one is the cash flow. That's what you're trying to get, especially free cash flow. And you can see it's really offering some compelling valuations here. And these companies are companies that are using their cash flow to buy back shares, to pay dividends, and to pay down debt. So it's really an interesting concept and a great value play. And this kind of gives you an idea. If you looked at the S&P 500 and you look at the Cambria shareholder yield ETF, and you can kind of get a feel, the top 10 stocks in each of these indexes and what is their shareholder yield. So you can kind of see you're getting a lot of yield off of the companies in this fund. The average is 8%. Whereas if you look at the average on the S&P 500, it's actually slightly negative. So even Apple, as good a company as it is, if you looked at dividends plus share buybacks plus paying down debt, Apple's really not providing that big of a return. But it's probably the best of all of the top 10 in the S&P 500. So looking for ways to get value. How are you getting cash for your investment? The other thing to look at is just it's really built differently than what the S&P 500 is. It's really focused a lot on consumer discretionary, on energy. We've talked about energy being cheap for quite a while now. You can kind of see for technology, it doesn't have a lot of technology as compared to the S&P 500. So it's a very different fund. It's more of a mid cap. So it's not large company stocks, it's mid cap, and it's very heavy into companies that are offering a lot of cash flow to investors through those 3 metrics. Another one I'm adding a little bit more to, we've already got this, but I'm going to add some more to it. is the Illyrian MLP index, AMLP. So what this is, these are what they call midstream energy companies. So midstream mostly means they're the companies that process the energy, the oil, the natural gas. They process it, they store it, and they transport it. So, you got a lot of pipelines and shipping companies, things like that. So it's basically from, when it's pulled out of the ground up to the point where it's going to be actually sold to you and put into your car, that kind of thing. So it's everything in between there. But I've always liked the MLP index because a master limited partnership is a tax structure. So what has to happen in order for them to avoid paying taxes at the corporate level? They have to distribute 90% of their profits to shareholders. Again, you're looking to get cash as an investor. So they have to distribute 90% of their money to you, of their profits. So this thing has got a dividend yield of, almost 7.5% roughly. So even if it sits and does nothing, you're getting 7.5% to sit there and just collect the money. But you can also kind of see, again, when you look at price to cash flow and then enterprise value to EBITDA is earnings before interest, taxes, depreciation, and amortization. So it's a lot easier to say EBITDA. But everything, again, really compelling valuations. And what's really sort of interesting right now is usually the past, I'd say the past 8 or 9 years, the MLPs have been really tightly correlated with the price of oil, which isn't natural because this thing, this doesn't depend on what the price of oil is doing because all they do is they process it, they transport it, they store it. It's really like they're just the middleman. And as long as people are putting gas in their car and heating oil in their house and things like that, then it really doesn't matter. But for whatever reason, this thing got tied for a few years to the price of oil itself. And as you know, out before inflation hit here in 2022, price of oil was very volatile and also on a downward trend. And even this year or the past year and a half, it's kind of been heading south. Well, the Illyrian MLP index is not doing that. So it's finally kind of acting strictly off of cash flows and not tying up to the price of oil. I think before it was like anything that was in any way tied to energy got tied to the price of oil. And it's not necessarily doing that right now. So it's kind of back to its normal where the market looks at, okay, what cash flows are coming from these things. And that's what they're basing the price on. I hope that it continues. It doesn't mean that it will. I mean, if oil probably dropped to 30 a barrel, this thing's probably going to go down too. But hopefully it won't go down as much as oil would if that situation arose. Okay. Since we're past 10 o'clock, I've got a few more slides, but it would probably be another 20 minutes or so. So maybe I'll bump that to next time. So yeah, I kind of apologize. It took me about 10 minutes to try to get everything going. I have problems getting one of the videos uploaded. So we'll just talk about some of the moves. I'm just making moves very, not whole hog. I'm not going whole hog into this thing. We're just doing little bits at a time. So we'll add just bit by bit to get into some more value because, I know it's really sexy with the investing in NVIDIA and all that good stuff, but I mean, it's just ridiculous on the valuations. And if you missed last Coffee with Kirk, check that video out because I have a few slides. And I've got a few more that I've got here. I'll probably hit those later, but these were some ideas for you to try to find some what they call deep value. So you want to kind of go into areas that probably are going to do well, even if the big tech stocks start to struggle a little bit. And if you go all the way back to the tech bubble of 2000, you actually could have done very well in the markets because what happened then is all the money, just like today, all the money ran to the hot tech stocks. And then when that finally imploded, there were so many value companies that had great dividends and low valuations, and they actually did pretty well. Things in the consumer staples, utilities. There were sectors that had been left for dead that all of a sudden actually were up during the 2000 to 2003 bear market. And some of them up substantially, just because at that point we had sort of the same situation where the tech sector struggled and then rates were rising. So people demanded more cash from their investments. And that's one of the things that surprised me the most so far about this. I thought with the Fed raising rates up to, over 5%, if you could go into a T-bill and get 5%, then you're going to kind of demand more cash from your stock investments. And that hasn't necessarily happened. The money's still just running to some of these tech stocks and crypto and some of the more aggressive stuff. It's kind of a disconnect from what usually happens. But that only lasts for so long. And at some point, something happens. I don't know what a trigger will be to kind of cause it to cascade. It could go on for a long time. Maybe it's got 2 more years of just ridiculous exponential straight up for some of these tech stocks. But, the thing is where the rates are, and if the rates don't come down, I think we're going to start to see that happen where people demand more for their stock investments. They demand more cash, and any kind of sanity that comes in, we're going to probably see a pretty quickly turn the other way. I don't know when that's going to happen, of course, but in the meantime, you kind of just buy things that offer really good valuations and deliver a lot of cash to you as an investor. And at the end of the day, you're going to be pretty happy. So anyway, appreciate you guys checking in on a Saturday, and keep the questions coming. I've got a few slides I'll do next time. They were mostly asking me to clarify some stuff on the Magnificent Seven. So we'll do that. We'll hit that again. Got a lot of questions on it. So we'll do that next time. All right. Have a great weekend, everybody. We got a little bit of snow up here in Maryland. So we'll have to do a little shoveling when I get home today. Anyway, take care. Bye.